how IUL eliminates the 3 dangers that cause most retirees to outlive their money. Now, in this episode, I'm going to talk about these 3 dangers: taxes, inflation, and market volatility, and how you can help your clients, or if you're a member of the consuming public and you're about to retire, I'll show you how we can eliminate those dangers for you by seizing 3 opportunities and harnessing the best strengths, and I'm going to show you the proof, okay? So get ready. You're going to be blown away because this will enable you to not outlive your money. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans prepare for a comfortable retirement and not outlive their money by eliminating the 3 big dangers that cause most retirees to outlive their money. So let's dive into this, and I want you to stay with me because at the end, I will gift you a free copy of my 300-page book, The Laser Fund. You don't have to go to Amazon and pay $20 to $70 for it. I'll gift you a copy free, okay? So here we go. How IUL eliminates these 3 dangers. Now, let me frame it by talking about the book Blue Ocean Strategy, which is a business best-selling book. And blue ocean connotes that there's a red ocean. Yeah, there's a red ocean out there where in the financial services industry, there's a lot of competition, and most financial advisors are trying to tear down all the other advisors, like tearing down all the other buildings in town so they're the last building standing. And as Zig Ziglar used to say, if everybody's throwing dirt, everybody's losing ground, okay? I've never bought into that. And so I learned that you focus on the client's DOS. DOS is dangers, opportunities, and strengths. And that's what I love to do. So many advisors spend 80% of their time in that red ocean. I like to spend my time solving your DOS. And if you were an advisor, I'd recommend you do the same thing. So what are the 3 big dangers that cause most retirees to outlive their money? Taxes, inflation, market volatility, without question. So I help people eliminate those dangers. I make them immune from those by seizing 3 opportunities. Convert at least 40 to 60% of their income to be tax-free. Then they don't have to worry about taxes going up. Some of our clients convert 100%. We've taken many clients from the highest tax bracket to a 0% tax bracket because they don't want to pay any taxes. It usually takes us 5 years to do that. We convert to tax-free vehicles, which is a structured, maximum funded property structured IUL. We link their returns to the things that inflate. I don't like inflation any more than anybody, but it doesn't hurt me, it helps me. I can outpace inflation by linking my returns in IUL to the things that inflate. And I'll show you that. And then you use indexing. I'm not talking about an index mutual fund. I'm talking about indexing a strategy. An index mutual fund is a commodity. And so I eliminate the danger of market volatility because when the market goes down, I don't lose. Now, the 3 biggest strengths of property structured IUL is liquidity, the ability to access your money when you need it. 2 is safety, not only of the institution, but safety of your principal. I don't want to lose money that I set aside, but any year I make money, I want that to become newly protected principal, meaning I don't want to lose in future years the money I made last year or in previous years. A lot of advisors don't know how to do that. And number 3 is to earn a predictable rate of return that historically has outperformed or outpaced inflation, okay? So how do we do this? The first danger, let's do a deeper dive in that. Taxes, tax changes that will affect everybody. So many taxpayers in America like this ostrich with its head in the sand and it's open season with the IRS, okay? And they just hope that they can make it through. Well, so many times when people would come to meet with me, I would tell them to bring their after-tax IRA and 401k account statements. Now, I knew they didn't have them, but they would go, after-tax statements? Oh, okay, well, I'll have to calculate it for you. Because they would look at here, we have $1 million in this IRA and 401k. I say, well, that's not all your money. Only about 2/3 of that is your money. See, this is what you think it looks like. This is what it really looks like after Uncle Sam takes his share out of it, and 41 out of 50 states has a state income tax. So it's Uncle Sam and the governor of their state, okay? So many people, I would say, were you planning your retirement or Uncle Sam's? because Uncle Sam has been your partner and will continue to be your partner if you keep deferring till age 72 and take RMDs. Why do you want to do that? Okay, you're funding the government forever, and they start to get a little bit of epiphanies, insights. So many times when I teach advanced continuing education to CPAs and tax attorneys, and they go, wow, this IUL is way better than IRAs or 401ks, but then they say, well, Doug, we don't have time to educate people like you do. So what the public doesn't know won't hurt them. And we're the ones who told them, well, yeah, go ahead and follow the herd and put money in IRAs or 401ks. We don't want to have egg on our face. Well, it does hurt them. So the poor public is the one that suffers. Back in 2009, after people lost up to 40% in the value of their IRAs or 401ks for the second time in that decade from 2000 to 2010, this was the cover story on Time magazine. I actually have a copy of this framed. Why it's time to retire the 401k and what you can do instead. Now, Stephen Gandel was the author of this, and he said, yeah, the 401k or IRAs, any of those, he called it a financial flop, a rotten repository for our retirement reserves. Now, I've never used that strong of language, but he was saying because of market volatility, the third danger, people should not have money in 401ks because most of them have it in the market. And the market, Wall Street, was never designed to create predictable income in retirement. So he said, no, 401ks. In fact, the champions of the 401k in 2017 lamented the day they ever came up with this idea. Okay. Now, I was saying, no, that's the third danger. The first danger is taxes. This premise that deferring in an IRA or 401k because you will likely be in a lower tax bracket when you retire is false. Most savers are not in lower tax brackets when they retire because they've been killing their tax deductions along the way by paying off their house. The kids are gone. If they move back in, you can't deduct them anymore. In retirement, they're not contributing money to IRAs or 401ks anymore. You don't have those deductions. If you're a business owner and you sold your business, you don't have those deductions. And taxes keep going up, as I'm going to show you. So most people are not in lower tax brackets when they retire. It would be better to get the taxes over and done with sooner than later. Okay. So these two things are absolutely certain. Money will never be worth more than it is today because of inflation, and your current tax bracket will likely be the lowest bracket you will ever be in. If that's true, which most Americans agree, don't keep deferring to some future perceived unknown advantage and then withdraw your money out of IRAs or 401ks later when you are convinced taxes will be higher. That's not smart. Okay. And so you start looking at the different presidents. Now, as of the recording of this episode, Joseph Biden, has been spending at least double and even triple what the IRS brings in revenue. The IRS, if the IRS brings in $4 trillion, they've been spending $8 trillion. I mean, if we did that, if we were only making $100,000 and we kept spending $200,000, we'd have to file bankruptcy. Well, the government won't do that. So what do? They raise taxes and they print more money. And that causes inflation, which is a hidden tax. And so as of the recording of this episode, it's an election year. And Biden is going to be increasing income taxes right after this election year, reducing 401k tax benefits for higher income earners, dramatically increase capital gain taxes. He's going to increase the estate tax by 50%. He's going to increase the corporate rate from 21 to 28%, which is actually 33% more money being paid by corporations. They can't afford it. He says they can afford it, not without laying off people, causing unemployment, and raising the prices of goods and services, which causes inflation. You raise minimum wage to 15 or 20 bucks an hour, and that's all gobbled up at the gas pump and the hamburger stand, okay? Health care and student loan debt forgiveness. He wants to keep spending, okay? And he's going to cover it by raising taxes and printing money. Now, if he doesn't, then the Trump tax cuts expire and the taxes are going to go up anyway, even if he doesn't get away with any of this. And it'll be the biggest tax increase we've ever seen when the Trump tax cuts expire. It's just the way it is. And so if people get duped into putting money into tax-deferred IRAs or 401ks, the government has a permanent tax lien on that money. See, deferred taxes in an IRA or 401k just means increased taxes. The government still is going to get at least a third or more. In fact, they'll probably increase their percent as you accumulate more money. So I would prefer to accumulate my money totally tax-free. That's in a property structured IUL. So in my books, I talk about the 4 phases of retirement planning, and you'll see this in the book that I want to give you at the end of this episode. See, most retirees, we go through the contribution phase where you're contributing money to long-term goals like retirement. You have the accumulation phase. Then you arrive at the distribution phase where you start withdrawing money. And then you have the transfer phase where when you finally die, anything left in the account transfers to your spouse or your kids, okay? Now, let's go through 5 different savings alternatives real quick to show you how taxes affect these. Unfortunately, most Americans save the worst way in tax-deferred investments. These are banks, credit unions, regular mutual funds. You're taking after-tax money, and every year you're paying tax on your 1040 tax return on the interest or the dividends or the growth. And any gains are taxed, and when you transfer it to anybody, it's taxed. Tax, 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 tax. That's 4 red circles, okay? That's the worst way to save, and I'll show you what I mean mathematically here. That's like crawling around a racetrack where we're trying to cross the finish line with $1 million net, the $1 million dash. The next method is to take after-tax money and put it into something that's tax-deferred, like a non-qualified annuity. Yeah, it grows tax-deferred, but if you start taking out money, it's now taxable. And it's tax LIFO, last in, first out. You're paying all the taxes on all the income because that's the first money out, last in, first out. And so you only get 1 green circle. And that's like walking around the racetrack. Now, let me show you mathematically, $1 doubling 20 times will grow to $1 million. Did you know that? It goes to $1 to 2 to 4 to 8, 16, 32. And it will grow to $1 million if it's not taxed. But most Americans have it in, tax-deferred investments. In a 25% tax bracket, $1 doubles to 2, and you pay tax of 25% on that dollar gain. Now you only have $1.75. That doubles to $3.50. Pay tax on that. Guess what? You'll only have $72,000. 7.2% of what you could have had, the million. This is the way most Americans save. If you're in a 33% bracket, instead of $72,000, you'll only have $27,000, 2.7% of what you could have had. This is the way most Americans save. Now, some smart, savvy ones go, oh, I put my money in a tax-deferred IRA or 401k. So let me ask you this. If you were a farmer and you had the choice of buying your seed that you're going to plant in the spring and you don't have to pay tax on what you pay for your seed. It's tax-free. So you buy your seed, you don't have to pay tax, you plant it, you cultivate, you irrigate, you work hard in the fall. Now you have crops that you harvest and you sell. And you agree to pay tax on what you sell your harvest for. Are you getting it? That's a traditional IRA or 401k. You get a tax break on the seed money, you enjoy the harvest without tax. Now, if you're convinced you're going to be in a lower tax bracket, that may be tempting. But most people agree where taxes are going to go up. I would rather pay tax on the seed and enjoy the harvest without tax. A Roth does that, but I've never owned an IRA or 401k, never will, and I've never owned a Roth IRA or 401k, never will, because a property structured IUL knocks the socks off of a Roth. Roths only have 2 benefits. IUL has 6 benefits. Those 2 and 4 additional benefits Roths will never have. I don't have time in this episode to explain them, but keep searching them on my channel, you'll see them. So if you put money in a traditional IRA or 401k, you're getting a tax break on the contribution and the accumulation, 2 green circles, but now the 2 red circles, as you take money out, it's going to kill you, and I'm going to show you this mathematically. Instead of doing that, I would take after-tax money, put it into a max-funded tax-advantaged IUL policy under Section 101A of the Internal Revenue Code. My money accumulates tax-free. I can access it tax-free. When I die, it blossoms and transfers income tax-free. Nothing else does that. I get 3 green circles, which is usually double, maybe triple the income of IRAs or 401ks, and it's even quadruple the income of one of these, where most Americans have their money, okay? Now, as a financial strategist, many times I'm able to resurrect deductions that clients have been killing, and I get 4 green circles, okay? I don't have time to go into that. You can study it in the book. I would rather have 3 or 4 green circles any day than 2, 1, or none. Are you getting it? Okay, so let's talk about this mathematically. If I have money in a tax-deferred IRA or 401k, then I'll have that $1 million. If that if that dollar doubling 20 times goes to $1 million, they have $1 million. In an IUL, I'd have $1 million. Let's just use apples to apples. So people say, what's the difference? The difference is you don't choose investments based upon which ones grow to the most. These two both grew to the same amount. You choose investments based upon which ones generate the most income. At the time in life, you're going to be using that money the most. So let's go to what I call the back 9 of an 18-hole golf game of life, retirement. So money that's invested in taxes earned or tax-deferred investments, it's out of money in 1 year. The IRAs or 401ks have $1 million in it, like the IUL. The difference is now you have to pay tax when you take the money out. Let's say your goal is to have a net of $100,000 to buy gas and groceries, prescriptions, and golf green fees after tax. In a 33% bracket, you have to pull out 50% more money. This person has to pull out $150,000, pay tax of a third, $50,000 to net $100,000. That IRA or 401k that had $1 million in it will be drained dry, gone in 11 years. That person at age 76, 77, will be relying on Social Security, charity, welfare, and their children for support. Money in the IUL, you pull out $100,000, you net $100,000. It's tax-free. I still have my $1 million when the IRA or 401k is out of money. And I keep getting $100,000 a year for another 20 years to age 95, age 96. And I still have my $1 million. 20 more years, $100,000 is $2 million, and I have another million. I have my $1 million, and that's a $3 million better retirement strategy than the same amount in an IRA or 401k at the same rate of return. It's profound. So that's why I prefer 3 or 4 green circles, because it generates income into perpetuity. Now, you need to understand there's only 3 types of income since 1986 tax reform that are subject to tax. Earned income, salaries and wages; passive income, which would be rental or lease income; portfolio income, that would be interest or dividends. Money out of IRAs or 401ks usually falls under this one. It's taxable. Money out of an IUL is not deemed earned, passive, or portfolio income. When my clients have $1 million in an IUL and they're generating $100,000 a year of tax-free income, the IRS knows they're receiving it. They know everything. But because that $100,000 of annual income is not earned, passive, or portfolio, there's nowhere on a tax return to put it. It's tax-free. It is cut and dried, okay? Let's go to the second danger, inflation. That affects everybody. It will double the cost of living, in my opinion, in 5 years or less. So during COVID-19 and inflation started exceeding 4%, all of the news networks in 2020, inflation's 4.2%. I always triple that. Why? I started in 1974. Jimmy Carter came in and we had double-digit inflation by 1980. And that's when the federal government decided they could not afford to pay Social Security recipients the actual cost of living increase. They had to change the way they reported the Consumer Price Index. And so starting in 1981, in the red is what the Consumer Price Index, the reported rate of inflation was, because they weren't comparing apples to apples anymore, the same basket of goods to the same basket. They could actually compare an 8-ounce filet mignon steak to 8 ounces of hamburger the next year. And they've been doing this for years. This is the actual rate of inflation. It's usually 2.5 to 3 times what the government reports the inflation rate, because they don't want to pay Social Security recipients what the real cost of living is. They can't afford it, okay? And so you even go from 2000 to 2021, this was what the government reported inflation was. This is the actual inflation rate. So when they said inflation was 9%, okay, during COVID-19, the actual inflation rate was about 27%. What did our clients get? 30, 61%, even 158% with IUL, because we structure it to do that. Now, you have to protect yourself from the negative impact of taxes, inflation, market volatility, economic uncertainty. That's time. By maintaining liquid assets safely earning returns. That spells laser. That's the laser fund. If we use rule of 72 math, if you don't know what that is, let's say you're earning 7.2%, because that's the worst that I've ever earned on Index Universal Life without rebalancing in the worst decade since the Great Depression. 2000 to 2010, you would have earned 7.23% on IUL. 5 years, you wouldn't have earned anything, but you wouldn't have lost. The other 5 years, you would have only capped out twice, but your average was 7.23%. $1 million would have doubled to $2 million in the worst decade since the Great Depression. People who have their money in the market, by the way, they didn't make anything. They were still down 38% at the end of 2010. If I'm earning 7.2% and I start out with 125 grand, without adding a dime, it doubles to 250 in 10 years, 500,000 in 20 years, $1 million in 30 years. I've had many clients experience this. So let's say you have $1 million earning 7.2%. Theoretically, you could pull out 72,000, but if it's an IRA or 401k, in a 33% bracket between federal and state tax, you pay 24,000 in tax, you're netting 48,000 to buy gas and groceries, prescription and golf green fees. That's 4,000 a month. I hope you can get by on that, but watch what happens with inflation. If inflation is 5%, 5 into 72 tells you the cost of living will double in 14.4 years, let's say 15 years. So in 15 years, okay, 4,000 a month is only going to buy what 2,000 a month bought 15 years earlier. You're going to need 8,000 a month to buy the same gallons of gas and loaves of bread that 4,000 a month bought 15 years earlier. 30 years down the road, because a lot of retirees, between a husband and wife, one will make it 30 years, you're going to need 16,000 a month to buy the same gallons of gas and loaves of bread that 4,000 a month bought 30 years earlier. Well, that's at 5%. At 10% inflation, the cost of living doubles in 7.2 years, 10 into 72. I've been talking about inflation exceeding 15. 15%, it'll double in 4.8 years. If the cost of living doubles every 5 years, you have to have a strategy where you are outpacing inflation. That is done by using indexed universal life and rebalancing annually, so that when inflation hits 15 or 20, you will earn 25, 30, 61%, and you will learn in my book and on this channel how our clients actually achieve that goal, okay? Let's quickly cover the third danger, market volatility. It's gonna keep happening. So again, a 25% loss has to be followed by a 33% gain to get back your money. If you have 100,000 and it loses 50% down to 50,000, 50,000 now has to double, have 100% gain to make up. So just eliminate the losses in the first place. In the Great Recession, again, November of 1999, people who saved their entire life to accumulate $1 million in their IRAs or 401ks, let's say, in the market, in the S&P, they saw that $1 million nest egg dwindle down to 650,000 from 2001 to 2003. It took 4 years until 2007 to make back what they lost. They had to put off retirement 7 years. They felt like they lost their future. Then in 2008, they lost 40% again. And it took 4 more years to come back to break even. They finally had 1,046,000. That 46,000 didn't even equal inflation. Now, our clients that had IUL, they were cheering when the market went down because they weren't losing. They didn't make much of anything, but they didn't lose. And as soon as the market turned around, they started making money from this point, not clear down here at this point. They didn't have to make up for the losses because they didn't lose anything. At the end of 12 years, many of our clients that started with $1 million ended up with $2.5 million, even $3 million, when their friends who had their money in the S&P were barely back to break even. That's the difference between linking to the S&P and actually having your money in the S&P. A lot of people don't understand this. This is superimposed, that Great Recession. That's a pathetic 1/3 of 1% compounded rate of return. That's unacceptable to me. if you had your money in an IUL and all you did was use one strategy and never rebalanced, which I wouldn't recommend, you would have 130% more. Most of our clients had 200 to 300% more by rebalancing. If I started in 1975 and had $500,000 in the S&P, I would have had all kinds of ups and downs, roller coaster ride, heartburn. I might end up with 5.6 million tax deferred. Using indexing, I may not have made as much, but I didn't lose. I would end up with 8 million in IUL. What would you rather have, 8 million with no heartburn, tax-free? Or even if you had all that and you ended up with 5.6 million, which most people wouldn't because they sell when the market goes down, 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 and they buy after it's come back up. They don't really buy and hold. If you did, you'd end up with 5.6, but you'd only net 3.8 after tax. What would you rather have? When I speak to audiences, they say this without question. Yeah, it's more than double. Now, let's end with this. Does IUL really work? I have critics out there that say, I've never seen an IUL policy that even begins to perform as the original illustration. Well, go to my channel here and check out the playlist on Does IUL Work, and we'll show you dozens of examples, okay? This is a sample of one annual statement from one of my son's policies. This client, by diversifying 20% of their cash value in their IUL into 5 different indices, this is what they actually earned on 20% of their money. 14.89, 10.25, 15.07, 8, and 13. Average those. It knocks the socks off of the 8 or 9% illustrated rate. Here is an example of March of 2020 to March of 2021 during COVID-19. When the market dropped 30% in March of 2020, that was anxiety, right? When there's anxiety, that spells opportunity. My sons contacted 800 of their clients in March and had them link to a 1-year point-to-point with no cap. We generally don't use that strategy because the insurance company has to subtract 5% off of the return. So if you only average 12, you only net 7. But in that case, the chance that the market was going to be up substantially was great. Sure enough, it went up 66.33% in 1 year from dropping 30%. It went up 66.33. Subtract 5, the net was 61.33. This client only allocated half of their money, $18,000 in their IUL. It grew to $29,000 in one single year. This client had $852,000 he linked. He got 61% in 1 year. That 852 grew to $1,387,000. He made $535,000 tax-free. If the next year the market dropped 40%, he would not have lost one dime of that $500,000 he made the year before. Because every year you lock in your gains and you reset, okay? That's the beauty behind this. This client had his IUL policy for 13 years. He had averaged over 13 years, 12.88%. That's way better than I think the 9% that we used in the original illustration 13 years earlier when he took it out. He had $110,000 of cash value. Do you know what his original illustration projected? $63,000. And he purchased this 13 years earlier saying, if I only have $63,000, this knocks the socks off of, anything else I could do with my money, whole life or IRAs or 401ks or anything. Well, instead of having $63,000, he ended up with $110,000. We do this all the time. How can you learn more? Study my book, first of all. Click on the link below or go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I require a little bit of skin in the game, but I'll pay for this book. It retails on Amazon for $20 to $70. I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy of this 300-page book, if you like to listen and learn and watch and learn, there's those various formats. But if you want to attend a free educational webinar, you can register for one of those, no cost obligation. But if you want to see how this works in your particular set of circumstances, you can schedule an appointment with a certified IUL professional. that has passed a stringent exam with 100%. Because if you're going to do this, you want to make sure it's structured correctly. And I could point you to a certified professional. That's the top 1/10% of IUL agents in America. If you're an agent and you want to learn how to become certified, go to IULinsiders.com/pro, and you can learn what's involved to become a certified professional. But claim a free copy of my book regardless. And I want you to begin to learn now and see the examples in the book. Read the stories. This will blow you away, and you will learn how IUL eliminates the three big dangers that cause most retirees to outlive their money: taxes, inflation, and market volatility.